and I'd short every tick on the way down.
Do you call this? You're supposed to be supporting a short play on Claxon,
Right.
but your numbers don't do the job.
This is ridiculous. You live here? $26,000 a month?
Let's talk about finance and business lessons from the 10th episode of Billion Season 2, based on my work experience at Goldman Sachs in New York City, and based on my work experience at the top hedge funds in the world. Now, please like, comment, and subscribe, and stick around, because at the end of this video, I'm going to grade the episode for Wall Street Realism with a buy, hold, or sell rating. Now, in this video, we're going to talk about 3 topics. The first topic is how to come up with short ideas, or how to avoid buying stocks based on 10 accounting issues. And even if you don't have any accounting or finance experience, I'm going to explain all 10 accounting issues from scratch. Now, in this episode, Axe Capital's short thesis is based on this accounting issue.
Take a deep dive into their financing department. Look at 30 and 60-day delinquencies, leasing, credit. They're all stretched. Every auto company is pushing sales forward with aggressive lending.
Congratulations. All the analysts now answer to you.
In topic 2 of 3, we're going to talk about one of the most influential authors when it comes to hedge funds, meaning Nassim Taleb, which hedge funds love to quote.
No, sorry, can't let it go. You truly are a black swan.
Now, he wrote The Black Swan and these other books, which we're going to quickly summarize in this video in order to help you become a better investor. Now, in topic 3 of 3, we'll discuss how much do some hedge fund employees spend on rent, where they live, and why this partially caused hedge fund Galleon and Rotman to get shut down by the FBI.
And this is your terrace. It's got 2,000 square feet, 360-degree views.
Topic 1, 10 accounting issues that might help you avoid buying stocks or help you to short them as part of your investment thesis. Let's start with analyzing Axe Capital's short of auto company Claxon.
Every auto company is pushing sales forward with aggressive lending.
So accounting issue number 1 is making sales go up by extending too much credit to customers, meaning using aggressive lending. And the classic example of this was the financial crisis of 2008, where mortgage brokers made it easier for homeowners to buy houses by providing loans to customers that had poor credit ratings. And one way to monitor if this is happening is explained here by Taylor.
Take a deep dive into their financing department. Look at 30 and 60-day delinquencies, leasing, credit. They're all stretched.
Now, by law, companies must disclose material risk in their filings. And so let's quickly look at auto company Ford's annual report, meaning their 10K, by going to sec.gov, and then let's type F for Ford's ticker, and then let's select the 10K, meaning the annual report. Then we can go to their credit finance receivables, and we can monitor the changes in 31 and 60 days past due amounts. And we see here that it's constantly less than 1%. Now, if you see a massive spike in this percent, then it could be a red flag. Now, to put this into context, according to the Federal Reserve, the current residential real estate delinquency amount is 1.7%. And it got into the double digits, as you can see here, in the financial crisis of 2008. And hedge funds monitor this very, very closely. Now, Axe was so impressed with Taylor's short thesis that he said this.
Bonus Taylor 500K.
The end of the year.
No, now. Mid-semester bonus.
Not accurate. That doesn't happen. Bonuses are almost always at year end. Let's move on now to accounting issue number 2, which is if companies pull forward revenue from future quarters to current quarters. Now, have you ever noticed how a company you follow might beat revenue and earnings in a quarter, but the stock goes down a lot, and you're like, WTF, why the face? Well, this can happen if deferred revenue growth deteriorates. Now, let me explain this from scratch. So if I sell you this pen for $1, okay, and you give me $1, but I don't give you this pen, then by law, I cannot recognize this as revenue in the current quarter until I give you the pen. If I recognize this as revenue before I give it to you, then I can go to jail, just like the former CEO of Computer Associates, Sanjay Kumar. Now, this $1 in revenue for this pen here is classified as what's called deferred revenue, meaning revenue that is deferred to be recognized in a future quarter. And so with this balance sheet right here, deferred revenue is actually a liability. So it goes right here. Okay, it's a liability because we're liable to deliver that pen to you. And so the $1 here is an asset. Okay, so it goes here on the balance sheet in the asset section right here. And we have $1 here for deferred revenue, so our balance sheet balances. Now, it's not a bad thing to have a high dollar value of deferred revenue because it indicates that our pipeline of future business is good. And next quarter, when I give you the pen, then this $1 in deferred revenue comes off the balance sheet and it's recognized as revenue. Now, if a company reports amazing revenue and EPS in a given quarter, but deferred revenue goes down a lot, then this is a concern because it indicates that the pipeline of business for future quarters is not great. How do we quantify this? Well, we look at something called bookings, which means revenue from the current quarter plus the change in deferred revenue from our current balance sheet versus the prior balance sheet. And if bookings, meaning this formula you see right here, goes down, then it could imply that our pipeline of future business is getting worse. And Sanjay Kumar broke the law because the last month of the quarter for Computer Associates was not 30 days. Rather, it was 35 days. What does that mean? Well, he took 5 days worth of deferred revenue from the next quarter and recognized it as revenue for the current quarter, which is against the law. Accounting issue number 3 of 10 is all about this game right here, ET. And when I was 10 years old in 1982, all I wanted for Christmas was this game. But it was the worst game ever, and it looked like this right here. And the Atari Corporation made close to 1 million of these things, and many people didn't buy them. So what Atari had to do was they had to bury 728,000 of these things in a landfill in New Mexico. And this was such a disaster that it almost pushed the entire video game industry into bankruptcy until Nintendo came along and released their 8-bit home console. Now, what the heck does this have to do with accounting? Well, if you make a lot of inventory, it goes in the asset side of the balance sheet here, okay? Aren't assets supposed to be a good thing though? Not necessarily, because many investors look at current assets and current liabilities. And current assets is supposed to mean you can convert current assets into cash in less than 1 year. Well, people look at current assets divided by current liabilities, which is called the current ratio. And we want this to be above 1 because we want our current assets to be greater than our current liabilities. However, the current ratio includes inventory. So what we can do is instead, we can calculate this ratio excluding inventory, which is called a quick ratio. And we want our quick ratio to be above 1. Accounting issue number 4 of 10 is financial statements are reviewed, meaning audited by auditing firms like E&Y, PwC, Deloitte, and KPMG. Now, if you notice that a company that you're doing research on changes its auditor, then in most cases this is a red flag because the auditor might not agree with the accounting processes of the underlying company. Also, if a company you want to invest in does not have a top auditor, then don't invest. For example, corrupt crypto firm FTX did not have a well-known auditor. Accounting issue number 5. If the CFO resigns, then in almost all occasions where there's smoke, there's fire. Even if they say they're resigning for personal reasons. And I do feel bad saying that because I'm sure there are legit personal reasons why CFOs resign in some cases. Just be careful though. Okay, accounting issue number 6. If you buy this pen for me and I give it to you, but you still owe me the money, then it's classified as a current asset on my balance sheet called accounts receivable. And if the growth in accounts receivable is faster than the growth in revenue, then this could be a red flag because there's a risk that we never receive that cash. Now, if a company is scared that they might not make their revenue quota at the end of the quarter, then they could call a customer and say this, hey, let me ship this product to you and I'll recognize it as revenue and just pay me later. Now, this is often referred to as channel stuffing. So be really careful if you see a spike in accounts receivable relative to revenue growth. Accounting issue number 7 out of 10, slowing organic revenue growth. If a company buys another company, then it might look like the revenue is growing a lot year over year. However, the organic growth rate, meaning the growth of the company's internally created product or service-based revenue, might be deteriorating. Now, an example of this is the 2015 acquisition of Lynda by LinkedIn. Investors loved the deal as it made it look like revenue growth was really high. But then 1 year after the deal, meaning in 2016, investors were not happy with LinkedIn's organic, meaning real revenue growth. As a result, LinkedIn missed the street's expected revenue number, which caused LinkedIn stock to go down a lot. Then investment bankers called Microsoft and told them, hey, now you can buy LinkedIn on the cheap and maybe keep Microsoft Outlook relevant. Quick side note, we will discuss investment banking and IPOs in detail before the end of Billion Season 2 with the Ice Juice IPO. Accounting issue number 8 is decreasing revenue disclosure. Years ago, Oracle used to disclose its database and applications revenue in their financial reports. Then, in order to potentially not show the slowing organic revenue growth of its database sales, it stopped reporting database revenue. And some investors were worried because Oracle made so many acquisitions, including these ones you see here on these dates. And this might be a signal that organic revenue growth was deteriorating, even though the current CEO, Safra Catz, who was the CFO, is a financial engineering genius. Accounting issue number 9 out of 10, rising debt levels in order to finance growth. One way to measure this is by looking at debt divided by equity. If the number is greater than 1 or even close to 1, this could be a material red flag. And another way to monitor this is to look at the interest coverage ratio, which is calculated by taking earnings before interest and taxes divided by interest expense. Now, if that number is less than 1.5, then this could be a red flag and imply that the company might eventually not be able to finance, meaning pay the interest on its debt. Accounting issue 10 of 10, expenses rising faster than revenue. And this one is easy to understand. Now, on an income statement, where revenue or sales mean the same thing, where revenue or sales is the top line, if you see that expense line items like sales and marketing or general and administrative or cost of goods sold are rising much faster over time than revenue is, then this could signal that the company might have financial difficulties. And another way to think about this is by looking at deteriorating profit margins like gross profit margin, operating profit margin, and net profit margin. Now, when you look at these 3 formulas you see here, and all formulas in general, please always assume that the denominator is a number of 1. For example, if your net profit margin is 3%, then that means for every $1 in revenue on the denominator, you're generating 3 pennies of net profit. Quick side note, if a company has a PE of 10 times, that means for every $1 in earnings per share on the denominator, investors are paying 10 times that $1 in EPS. So always think of the denominator as being the number 1. And later this year, I'm releasing a forensic accounting elective that all my students will get for free in my MBA programs. For more details on my MBA programs, please see this link right here. Topic 2 of 3. Let's discuss one of the most influential authors when it comes to hedge funds, Nassim Taleb, who is quoted often in Billions.
As Taleb says, become anti-fragile or die.
Now, Taleb is a Lebanese-American author and former options investor, and I'm also part Lebanese, and I've actually met John Mack. And after I met him, he was the former rock star CEO of Morgan Stanley. He gave me this book here and this nice little note. Remember, your network is always your net worth. Let's quickly summarize 5 of Taleb's books, which are part of his Inserto series, starting with Black Swan, which the Sunday Times called one of the 12 most influential books written since World War II. Now, black swans are rare events, except in Tasmania. And a black swan event is a rare event that we cannot forecast in finance, like 9/11 or the COVID crisis. And these rare events can have a material impact on our lives and can cause massive stock market volatility and even cause the VIX to spike above 70, which is always the best time to buy, as explained in my Billions vlog on Season 2, Episode 8. Now, Taleb argues that we can't predict black swan events, but we can prepare for them by being very flexible and open-minded, especially when it comes to investing. And so we need to be contrarian and buy when there's blood in the streets. Moving on to Taleb's book called Fooled by Randomness, which my boss at my first hedge fund had me read the week before I left Goldman to join hedge fund Kingdon Capital in 2003. And Fortune called Fooled by Randomness one of the smartest 75 books ever written. And Taleb explains that randomness has a huge impact on our success or failure. He also says that humans make the mistake of finding patterns in random events. For example, day trading, which does not work as I explained in this vlog here, because each month has 20 weekdays, meaning 20 days where the major equity markets are open. And random events that we can't forecast leads to volatility, like geopolitical comments, economic data points, etc. And a great quote from Taleb is this: more data, such as paying attention to the eye colors of the people around when crossing the streets, can make you miss the big truck. And this is why I always humbly recommend being a long-term investor so you don't get fooled by randomness. Now, the third of 5 books is called Antifragile, where Taleb explains that you win by embracing chaos or disorder because it makes you stronger. So we need to always learn from our failures and ask ourselves, what's positive about this? Or what can we learn from this so we never make this mistake again? For example, why did we panic sell that stock? Shouldn't we have been unemotional and seen that as a buying opportunity from a post-mortem perspective? And another great Taleb quote is, a mistake is not something to be determined after the fact, but in light of the information available until that point. And Taylor right here discusses why, ow, it hurt my hand, I almost got cut off there. Taylor here discusses why letting the town of Sandicott go belly up is not a bad thing when Taylor quotes Taleb as follows.
People might say you hurt this town, but in my opinion, the town put the hurt on itself. Corrections are in order. There's a way to make this work, and that way is hard, but necessary. As Taleb says, become anti-fragile or die.
Now, the final Taleb book in his Incerto series that we will discuss is called The Bed of Procrustes, who was the mean son of Poseidon. And in this book, Taleb encourages us to question what we know and know that things are more complicated than we think. Basically, think differently in order to come up with groundbreaking ideas, and don't get too comfortable with things that might be holding you back. And another great Taleb quote is, wind extinguishes a candle, but energizes a fire. Skin in the game, where he states that if we take ownership with a risk, then the outcome could be better. For example, paying employees with stock options so that we all have skin in the game and we all succeed because we are all owners. And Taleb criticizes government officials or bankers that don't have skin in the game when it comes to the failures of customers, shareholders, or even voters. And we all need to have personal stakes in our decisions, which is why I love companies where you eat what you kill, meaning a meritocracy, where you know how much you will or will not be compensated, which is why I love being an entrepreneur and not part of a political or bureaucratic company. Now, a great quote from Taleb is, never ask anyone for their opinion, forecast, or recommendation. Just ask them what they have or don't have in their portfolio. Topic 3. How much do some hedge fund employees spend on rent? Where do they live? And why this partially caused hedge fund Galleon and Rotman to get shut down by the FBI.
$26,000 a month. The place I live now costs $1,200.
Taylor, you're the golden child. End of the year, Axe is going to bonus you 1.5 minimum.
From this and buy something.
Now, Taylor just paid first and last month rent on a place that costs $26,000 per month to rent. And according to Chase Bank, we should never spend more than 30% of our income on rent. So if Taylor makes $1.5 million per year, then this means the maximum rent should be $500,000, which over 12 months is about $42,000 per month. Now, here's the problem though with what Taylor just did. At hedge funds, you always have to live well below your means and try to live off your base salary and not your bonus, because you can be out of the job in 12 months. Now, what should Taylor assume for a base salary?
Congratulations. All the analysts now answer to you.
That's not accurate. There's no way a relatively new employee like Taylor would be put in a senior position that quickly. But since Taylor is the head of research and a portfolio manager, we can assume conservatively that Taylor's base salary is about $500,000. And that means that the most Taylor should pay for rent is 30% of $500K divided by 12 months, which is $12,500 per month. So Taylor is spending way too much money on rent. And this leads to problems because we always need to live way below our means. And I had a friend that worked for Raj Ratnam at Galleon, which got shut down for insider information by the FBI. And I asked my friend why people break the law. And he explained to me, and of course we can't justify breaking the law, but he explained to me that the people he worked with there lived way above their means, and they spent like $30K per year on preschool for their kids. And many of them rented apartments that assumed that they would always make at least $1 million per year. And the problem with this is that once you provide your family with an insanely high standard of living, it can influence some people to compromise their integrity and break the law through insider information. Now, let's assume that a portfolio manager thinks that they will make $1 million every single year at a minimum. Then this assumes that using 30% max for rent, this assumes monthly rent of $25,000. Now, what can you get for that in New York City? Well, let's go together to Zillow and let's search for rentals in Manhattan that cost about $25,000 and see what this gets us, which you can see right here. Now, if you work at a hedge fund and expect in a bad year to make $300,000, then it makes sense to never pay more than 30% of this amount in annual rent, which equals a maximum monthly rent of $7,500. And New York is brutally expensive. And it took me until my 30s until I could afford a decent apartment there for my family. And I bought right after 9/11, and it felt so uncomfortable to buy. But in hindsight, that humbly was the best time because not many people were buying then. One final thought-provoking quote from Taleb is this: "Difficulty is what wakes up the genius." Let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. The episode did a superb job of outlining a short thesis based on extending credit terms. And I found that the best performing investors that I've ever worked with didn't just stick to analyzing equities, but also fixed income. In fact, successful hedge fund equity PMs often have friends that are fixed income experts. Now, in this episode, the fact that Axe gives Taylor a mid-year bonus of $500,000 and promotes Taylor to a very senior position that early in a career is not realistic. As a result, I'm going to give this episode a sell rating. Please subscribe, and I will see you soon in our next reaction video when we react to Season 2, Episode 11. Thank you.